Thank you, Andrew, and Prime Minister, former ministers, and distinguished guests all. Thank you for inviting me back again. I was told that I was invited back because I was funny last time, but Richard, you've warmed the crowd up, and I can tell you there is absolutely nothing funny about the Australian banking industry. And I think Saul Eslake will confirm that. David Lovell's introduction in the conference program, in fact, makes a couple of statements that I thought were pretty important. Adversity does not equal crisis. And secondly, maladroit government responses are caused variously by inexperience, secrecy, arrogance, and its cousin denial, inattention, and at worst, incompetence. I want to argue in the time that I have available this afternoon that while the Australian financial system is tied to the fortunes and misfortunes of the global economy, between 1998 and 2007, a strong economy, the regulatory zeal, a whatever-it-takes attitude by the banks, L-plate supervisors, and a government happy to let it rip, laid the groundwork for future crises in the Australian banking industry. Of course, I can say this because there's no better vision than 2020 hindsight. And I think probably a most important point to start is not back at the beginning of the Howard government and the time frame that we're looking at, but in fact at the Hayne Royal Commission that handed down its report 2019. It seems only yesterday, but it was 2019. And what that particular Royal Commission exposed was an absolute litany of issues that didn't simply arise from the time of the GFC in 2007 onwards. The commentary that accompanied Hayne's Royal Commission report was as damning of regulators, of various governments, of people not really seeing the avarice and the way in which the Australian banking industry, and in fact parts of the commercial world in Australia, for that read HIH Insurance, were starting to undermine the very fabric of what we came to expect, or should expect, A, as consumers, but what we expected in a corporate governance sense, particularly from boards sitting around in their somewhat ivory towers of the Commonwealth Bank or NAB or whatever it might be. Now, of course, I've got to do a disclaimer here. I'm the chairman of the Bank of China here in Australia at the present moment. Have been for the past 6 or so years. Hope to be there for a bit longer. I did mention China, so I'll just get a bit of a check here for ASIO and ORCAS and a few of the other interested entities around the globe. But very simply, I think it's a fact that, you know, the Prime Minister of the day, John Howard, had an economy that was going pretty well. As we heard this morning, tickety-boo, really. Some of the issues around outlay, some of the issues about the way in which funding was found for various programs of the government, simply was a reflection of a moment in time for that particular government. And to the credit of the government of the day, again, some of the decisions that were taken were all about taking forward the deregulation that had been put in place previously by other governments, one which I happen to be a very important part of, and because of various inquiries that set the scene for deregulation in financial services and, importantly, the internationalisation of Australia. Now, it started with Campbell, it went then to Vic Martin, it then went to Stephen Martin, that was me, parliamentary inquiry, and it went to Wallace. And it then went to Hayne in 2019. And all the way along there, we found that the appetite for continuing to have deregulation in the Australian financial services sector was not diminished, but sadly, I argue, what we did see is that perhaps the eye was taken off the ball by some of the decisions that were made within government, but certainly as well by those that were charged with the responsibility of regulating the financial services sector. Now, the 1990s, in fact, were marked by serious financial dislocation and the substantial banking sector losses, from which a gradual recovery started. The 2000s, as we heard earlier from Saul Eslake, were relatively tranquil until the global financial crisis and also the global tech stock boom and the bust and collapse that happened thereafter, and of course HIH. With the exception of HIH, though, neither the Asian financial crisis in particular, but also the global shock that came from the tech collapse had very little effect in Australia. And that was because of the policies which governments in the lead up to that time had pursued around deregulation. But at the same time, that period sowed the seeds of excessive lending, leverage, underpricing of risk and inadequate governance and regulation. And Australian monetary policy and other regulatory authorities, in fact, exercised a degree of restraint, and excessive profitability and remuneration issues emerged which were not seriously tackled until the Hayne Royal Commission. Now, Australia, despite competition, despite the support for deregulation, and I have to say I was part of a government that started the process and was absolutely enmeshed in it and supported what subsequent governments did as well. But the fact of the matter is, improvements to competition that were promised because of the entry of foreign banks, with the exception of mine, that also applied in terms of smaller entities like building societies and credit unions undertaking banking enterprises. The fact that all of this was happening, but there were still 4 major banks in Australia. And nothing got in the way of those 4 major banks gobbling up some of the smaller entities and then rebadging some of them and putting them back out into the marketplace as if they were something completely different. So privatisation, mergers, acquisitions were ever part of that landscape. But with this sort of deregulatory zeal came a new spirit of entrepreneurship that saw many of Australia's banks adopt a whatever-it-takes business approach. The consequences of this arguably unfettered and ravenous behaviour saw regulators eventually refine corporate governance standards in an effort to rein in the cowboys. But to paraphrase Gordon Gekko in the movie Wall Street, the attitude at the time was greed, for lack of a better word, is good. And that fundamentally was one of the problems here. And the question then is, should the government have its eye a bit more on that game? Now, I indicated that there were a number of different inquiries that were undertaken, and one that John Howard particularly put in place and was interested in to see the end result was the Stan Wallace inquiry, because what Stan recommended was in fact a new prudential regulator be established, and that was APRA. He recommended that a new market, conduct and consumer protection regulator for financial services be created, and that was ASIC. He said that the Reserve Bank of Australia should be left with responsibility for monetary policy and the payment system, but he said all of them should come together on a regular basis and create a Council of Financial Regulators, which was a forum for discussing the economy, economic developments, the financial system and what needed to be done. All that happened. John put them in place. It was terrific. Great things were promised. Regulators out there looking after monetary and other financial policies for the Australian economy, which would guarantee that the participants in that, read that, the banks, would act properly, would act correctly, would have proper corporate governance programs and processes in place. But sadly, it didn't happen. So if you fast forward to the Royal Commission of Hayne, what did he say? Well, I mean, it's a bit of a litany, this. What he found, there was financial planning scandals, interest rate rigging, a failure of financial institutions to properly develop accountability, trust, responsibility and culture, money laundering for drug syndicates, turning a blind eye to terrorism financing, ignoring statutory reporting responsibilities and inappropriate and improprietary in foreign exchange trading, and charging fees for dead people. I mean, not even the Labor Party would sign up dead people as branch members, but the banks were charging fees for these folks. Now, I found it absolutely instructive to read one of the comments that Hayne made when he handed down his report. Bear with me just for a minute, because I think this quote captures the absolute nub of what that problem is and the way in which banks were permitted, because of lack of supervision, I argue, and perhaps lack of government intervention at an appropriate time. Sorry, my phone's ringing going through my hearing aid. Just give me half a second here, if you don't. It's age, you see. I'm turning something tomorrow. So what Haynes said was this. Why did this behaviour develop? The answer seems to be greed, the pursuit of short-term profit at the expense of basic standards of honesty. From the executive suite to the front line, staff were measured and rewarded by reference to profit and sales. When misconduct was revealed, it either went unpunished or the consequences did not meet the seriousness of what had been done. The conduct regulator, ASIC, rarely went to court to seek public denunciation of and punishment for misconduct. The prudential regulator, APRA, never went to court. Much more often than not, when misconduct was revealed, little happened beyond apology from the entity, a drawn-out remediation program and protracted negotiation with ASIC of a media release, an infringement notice and an enforceable undertaking that acknowledged no more than that, and ASIC had reasonable concerns about the entity's conduct. Infringement notices imposed penalties that were immaterial for the large banks. In fact, sometimes the banks would go to ASIC and say, "How much? Look, this is what we think we should be paying." And ASIC would say, "Yeah, that's okay, we'll take that. That'll be enough." Instead of it being the other way around. Enforceable undertakings might require a community benefit payment, but the amount was for less than the penalty that ASIC could properly have asked a court to impose. I mean, seriously, you couldn't write this stuff, but Hayne did. Hayne found that in a royal commission into the banking system in this country, in the lead up to his report being published in 2019, this unconscionable conduct was being conducted by the mainstays of Australia's economic well-being. So, with that sort of background, leaping into the future but then coming back again, were there crises, as we might define them, in banking during the Howard government that led to such damning revelations in the Hayne report? I think to look at that, there's one other thing that needs to be said, and that is that the structural nature of the Australian economy at the time, which was set in place by the government of the day, contributed to some of these issues. The first, of course, was the independence of the Reserve Bank. Now, great thing for it to happen. Nothing like having an independent Reserve Bank. Nothing like having an independent Reserve Bank that puts the interest rates up in the lead up to an election. Oh yes, that was 2007 and 2021. Had no effect whatsoever. The Four Pillars policy, much. The Four Pillars policy, that is, what it didn't do, while it said we're going to have 4 major banks trading in Australia, it did not prevent them from gobbling up the smaller entities. And bank branch closures because of technology changes. Now, this was more a political problem than anything for the Howard government, because most of these branches were being shut down in rural and remote parts of Australia. Now, it was the National Party part of the coalition that were more concerned about this, and in response to that, the bank said, all right, well, we'll hold off a little bit. That was for about 5 minutes, and then they started the process of shutting all the banks down again. These used to be the hubs and the financial wherewithal of small communities in rural and remote Australia. Technology was catching up, but it still had a long way to go. The second major issue that occurred at the time, and is alive and well today, as we well know, concerns interest rates and housing affordability. With the ubiquitous prosperity, the cheap money and the tax breaks for homeowners and investors, questions arose in the term of the Howard government on the likely emergence of a housing bubble and the negative consequences for Australia when inevitably that was going to burst. Australian home prices had risen about 250% from 1989 to the early 2000s. We hear people talking about 17% increases at the moment. Let that figure sink in. All capital cities saw strong increases in property prices, and with record low wage growth, low interest rates and record household debt equal to about 130% of GDP. So it was a potent mix, if you like, in the economy, which was ripe for people to exploit. And the interest of interest rates in banking policy and property prices should never be understated. Financial deregulation led to greater availability of credit and a variety of financial products and options. The Reserve Bank of Australia, for the main, maintained a low cash interest rate policy. The ease availability of interest-only loans made possible for property investors to borrow to purchase a property and compounded the benefits of negative gearing. So all of these things were happening at the time. APRA stepped in for a short period of time and tried to rein back some of the negative gearing aspects where there were tax breaks and so on, but it was ineffectual. And I would argue that perhaps this is something that the government of the day, Mr Howard's government, should have perhaps had a little bit more of an eye on as time unfolded, because there were several other things that happened at the time, as we know. We know that, for example, there was national disposable incomes increased by about 2.8% a year. There was a consequent rise in the number of two-income households, a relaxation in lending standards, an active promotion of real estate as an investment, population growth creating demand that was not matched by supply, planning and land release issues, and a tax system skewed in favour of property investors. Now, they were just some of the things that happened. There was new homeowners grants, and there was a reduction in capital gains tax and so on. All of this led to fairly substantial and loud voices being raised about the need to actually have an inquiry into what was happening with home ownership and what was happening and what was affecting home ownership in Australia. Well, the productivity obliged, and they did that in 2004, and they released their paper, which fundamentally said that general taxation arrangements lend impetus to the surge in investment in rental housing and consequent housing price increases. And they also looked at a couple of other things. The government of the day, Mr Howard's government, response to that said that there was no conclusive evidence that the tax system has had a significant impact on house prices. This is after the Productivity Commission said exactly the opposite. Now, as I said before, the banks and their avarice for increasing their profits, the remuneration issues associated with their senior executive, all of these things started to bubble along as well. Every quarter or every 6 months when the banks came out and announced their profits, you could just see the mob go berserk. Why was this happening? And why aren't we getting some of the benefits of competition and so on that we were promised? The final thing, I think, that was relevant at this period and during this period of time was that around, as I mentioned a little earlier, corporate governance and crisis preparedness. One significant issue Hayne identified was that the failure of banks to develop and impose appropriate corporate governance policies and practices, and the way in which the regulators failed to do something about it, really required a backward-looking approach to say, well, when all these entities were established, why weren't the corporate government expectations, corporate governance expectations associated with their establishment and their remit to monitor the banks, to see that competition was being delivered, to see that consumers were getting benefit, to see that the banks weren't ripping people off, to see that the traders, for example, at NAB in 2004 were not ripping off because there were rogue traders in the foreign currency exchange area, and suddenly we find there's something like a $360 million hole in NAB's finances, so they rush off and get PwC to do an inquiry to say, where did it all go wrong, fellas? And at the same time, APRA decides, well, maybe we better have a look too. And when APRA had a look, they found that, in the report that they produced in 2004, that line management had turned a blind eye to known risk management concerns because profit was king in NAB. Profit was king. But not only NAB. I mean, profit was king in all the four major banks, and others were trying to play catch-up as they were running along. Various operational procedures were never verified. There was no looking at more senior people to sign off on some of the things that were going on in the bank. Market risk failed to engage trading desks to effectively resolve some of these problems. The risk committee of the bank itself, the board, were never properly given information to make meaningful decisions. Well, let me tell you, if you happen to be on the board of a bank whose responsibility is to monitor the health and well-being and to provide the health and well-being of the Australian economy, wouldn't you think that you'd want to have reports coming to you about risks associated with what your bank was doing? I can tell you what, we do at my bank. But then we've got an extra set of eyes on us because A, we're a foreign bank and B, we're Chinese. So we dot the I, cross the T's 5 times before we sign off on anything. But these were the sorts of things that were around at the time. Culture was woeful within the banks. I'm not saying that. This is something that APRA found at the time and which Hayne has subsequently said down the track. The remedial actions about fixing culture, governance, risk management issues, training staff, the board having a proper escalation process, the board actually asking their risk committee to provide information to them that they could understand, the board having responsibility under the Corporations Act to know what they were doing, to be able to sign off on the accounts on an annual basis. All of these things were there. But my question comes back to the very fact, again, when these entities were set up, when the Howard government rightly pursued the regulation and continued to do that and added refinement to it, when we saw these sorts of things happening, when Productivity Commission said home ownership is a problem, affordability is a problem, and the government says, well, no, it's not interest rates, got nothing to do with that. And then when we find interest rates are starting to rise because the economic cycle starts to turn and it costs government. And we've seen that, as I said, 2007 and 2022. When all these things start to happen, you have to reflect back and say, well, look, if we were the government of the day, is there something we would have done a little bit differently? Would we be a bit more hands-on? Should we have been a little less supportive and gung-ho of what was going on within the business community when there was clearly a social dividend that needed to be paid? Now, you would expect me to say that, wouldn't you, coming from the other side of the aisle? But I have to say, I mean, I have always been a great defender and supporter of financial deregulation. I have always and fundamentally believed, and if you want to see further evidence of this, my PhD, University of Wollongong, year 2000, it's available there. I have always subscribed to the view that this has added a layer of genuineness to the way in which our economy can flourish, can develop. But at the same time, I continue to be amazed at the fact that those that we have charged with the responsibility, whether they be government or whether they be through royal commissions such as Hayne, seem to have taken their eye off the ball, seem to have said, we won't worry so much about this if it looks like it's all going well. Well, I'm sorry, but you only have to fast forward to today to look at the issues that are out there. Housing affordability, the massive increases in housing prices that are starting to come off the boil, the fact that investors have been getting into the market, but because of COVID have dropped off again. So in one sense, maybe that was fortuitous in terms of the Australian banking industry, but as it turns out, it wasn't. Because while APRA dropped off their focus on the banks because of COVID and there wasn't as much activity going on, Once things started to rip up again, they are in there like a frenzied mosquito with stuff coming out to us as an ADI almost on a daily basis about what we've got to do to improve culture, to improve risk, to carry out on an annual basis checks on the way in which our entire banking operation is going, audit committees, independent auditors employed. And we are just one of the smaller but largest foreign bank, second largest operating in Australia. You can imagine then the pressure that is on the boards of the Big Four, but you can imagine, as it should be, the pressure that is on the regulators to finally get there. Because as Haynes said, you know, when the going gets tough, they got going all right, but they went out the door. The regulators, in my view, owe it to the Australian public and owe it to governments for the problems that they did not foresee and did nothing about until it was a bit too late. And as a final note about all of this, after Hayne made his recommendations, the government said we're going to adopt them all. This was not John's government, but it was the government of the day. Might have been Turnbull, I don't know, a bit hard to keep up with it after that, but they said they will adopt everything. If you do a cross-check now of what's been done, particularly when legislation's necessary, guess what? It ain't happened. We're still waiting. So this new government up on the hill, more strength to your arm. Thank you.